Hello, everyone, and welcome to this presentation of the correct way to trade support and resistance. Welcome, my name is Steven Primo. I am the president and founder of Specialist Trading. And first and foremost, for those of you who are new to my webinars with FX Street, we are an educational company where I take all of my 37 years of experience in trading the markets and teach all of my students and members exactly what I've accumulated and what I use in my current trading. To give you a little background about myself, I've been trading, as I said, for 37 years. I started my career on the floor of the Pacific Stock Exchange. I was on the floor for a total of 16 years, and 9 of those years I was a specialist for Donaldson, Lufkin, and Jenrette. That's where we get the name Specialist Trading. For those of you who aren't familiar with what a specialist is, because there aren't really a lot of them around anymore, if you ever look at those old pictures of the people on the trading floor with a lot of paper on the floor and people yelling and screaming, the specialists were those gentlemen behind those large booths, those large wooden desks, and they specialized in anywhere from 50 to 60 stocks. This meant that if you wanted to buy or sell that particular issue, you had to go up to that person who specialized in that. He made the market for those. So that's what I did for roughly about 9 years. I left the floor in the mid-90s to manage money, to also trade my account. And about 7 years ago, I started Specialist Trading, which is just an educational company where I teach and mentor students and members in as many as 60 countries around the world, all the particular techniques and strategies that I currently use myself. So today promises to be a great presentation because I'm going to teach you what is, in my opinion, the correct way to trade support and resistance, and I'm going to give you an entry technique for trading support and resistance. But before we go on and we begin, I ask that you please take a moment to view our disclaimer. As I stated, I'm going to show you this entry technique for trading support and resistance, but please remember that we can in no way guarantee that any of the results I'm about to share with you will be repeated in the future. So please take a moment to view our disclaimer. And as you're doing that, I'd also once again like to thank all the good people at FX Street for giving me the opportunity to speak on a monthly basis. I've been doing these webinars for some years now, and I want to thank you, and they've so graciously put together a microsite for us. As you see there, in blue is the link there that you would copy and go to your browser. So we've kind of shortened it down. If you see the lower yellow link here, this is where you can go to get more information about my website and also about me, if you'd want to get more information about me as well. Our sister site is Pro Trader Strategies. They market and promote all of my individual courses and strategies, so we'll give you more information about that, as well as my course descriptions, as well as a little bit of bio about myself, okay? And then I also want to invite each and every one of you to follow us on Twitter. There's our abbreviated name, at SPCLSTTRADG. We give a lot of great free information posting from now all the time, 3 or 4 times daily. In fact, just a couple of days ago, we posted that all of our members received a signal that was generated in one of our most consistent strategies to go short the Australian dollar. And so most of those gains, as you can see, if you're following the Australian dollar, we have roughly about 150 pip gain in just a couple of days. So that was posted on the our Twitter page as well. We also post information for stocks and for currency trading, as well as e-mini trading as well. So a lot of great free information there on a daily basis, and I invite each and every one of you to follow us on Twitter. Now, one of the last things I want to mention is that I will take questions. This is a classroom. I like to teach. Once again, this is an educational company. But if you have any questions, kindly wait till the end of the presentation. That way we can kind of move on here and flow nice and smoothly. I have a lot of great free information to give you that you can start using as early as today, but I just want to make sure that we keep the presentation moving along. Now, as I stated, I used to work on the floor of the exchange, and contrary to what a lot of people believe is they think that, well, if you worked on the floor, you have a license to steal and everything comes easy to you. And that's not true. I struggled for years trying to trade and make money, so I know what many of you may be going through. I know it's very difficult and it's very discouraging, putting in a lot of hard work, and trying to learn as much as you can, going to the webinars, going to presentations, reading a lot of books, paying for a lot of information, and then not seeing anything as a result. It's very discouraging, and you start to really lose a lot of confidence in yourself. I was going through the same thing. It took me over a year or so until I finally came in contact with a number of mentors on the floor. These were also specialists, but they had been trading for about 30 or 40 years. And they said, Steve, the reason why you're losing money is 2 things. First of all, your trading plan is far too complicated. You're listening to too many things. Your screen is just full of indicators. It's too complicated. And then lastly, you're relying on outside sources to tell you what to do. In other words, because I was on the floor, I thought I had information that was privy only to myself and not the standard public. I knew where orders were being placed. I knew where the institutions were. I knew where support and resistance levels were. I knew the inside news. And so I knew all this information, and it wasn't helping. I wasn't making a dime. As well, I was having far too many indicators. I was waiting for all these technical things to cross and to line up in order for me to take a signal. So it was far too complicated. I was relying on what I had been taught was supposed to work, but it wasn't working. The conventional wisdom wasn't working. So what my mentors taught me and what I teach all of my students is the same thing I'm going to share with you right here. It is the easiest thing in the world to complicate your trading. Anyone can do that. It doesn't matter if you've been trading for 30 years or 30 minutes. You can fill your screen or your trading plan with tons of information telling you what to do. It doesn't take a lot of intellect and a lot of discipline in order to do that. It's very simple, but it's the most complicated and the most difficult thing in the world to simplify your trading. All right? Why? Because we want to hang on to these things that we've been taught work. All right, I was always told that certain things about support and resistance that would stand the test of time and that they would work. But when I tried them, they would work for a little bit until they stopped working. And so I had to simplify my trading in order to get to that level which I wanted, which was consistency. All right, so what we teach at Specialist Trading is a way to get you on the road to consistency. We're not going to sit here and tell you that you're going to make thousands of % a year. We wouldn't do that. We would never promise anyone like that because we don't believe that's realistic. But what we do believe is realistic is a certain consistency in your trading. 2 steps forward, 1 step back. From time to time, you will have small, relatively small losses, but it's more about believing and trusting in what we teach you so that you can become the master of your own fate. You can rely on your own trading process. We don't want you to rely on our strategies and our signals to tell you what to do. We want you to be a part of the process, okay? All right, so that's just the philosophy of specialist trading, and that's what got me on the right track to being consistent, not to making millions and millions of dollars, but just to being consistent so that I've been trading nearly 40 years, and that's what it's all about, being able to trade for a sustained amount of time as opposed to those traders that make tons of money and then are wiped out the next year. There's nothing complicated about that. Anyone can do that. It's just like hitting a jackpot. What we're aiming for is sustainability in your trading plan and becoming consistent. All right, so here's what you're going to learn today. And once again, if you have any questions, kindly just write them down or wait for the last 5 or 10 minutes, and I promise we'll get to each and every one of them, okay? So we'll get to each and every one of those. All right, we're going to talk about conventional trading, what we've been taught and what I was taught, what is the conventional way to trade support and resistance. We're going to show you the conventional standard definition of support and resistance, all right? And then we're going to show you how it really doesn't work, how there's no consistency to that. And then we're going to talk about what we feel is the true definition of support and resistance. You're really going to be surprised how simple it is. Then I'm going to show you the correct way to trade support and resistance by entry technique. I'm going to share with you an entry technique that is so simple but will get you on that road to consistency. All the things you've learned about trading this way, you can throw out the door. It'll just be so simple and easy. You'll see it right in front of you. You can start applying this as early as today if you like, but we always recommend to paper trade. We don't want you to start doing anything until you fully understand the process. And then lastly, I'll share with you another technique which you can add to your support and resistance trading, which will greatly increase your odds for success. So this was we're going to show you how to even ramp up your odds for success and being consistent even more by the end of this presentation. All right, so let's talk about the conventional trading of support and resistance. This is the way most people trade support and resistance. This is the way you've been taught. This is the way I was taught, and this is the way I used to trade, and it would work maybe 3 or 4 times, and then the 5th time it wouldn't work, and I'd give everything back. Also, I'm going to start out by showing you a lot of examples in all the markets, stocks, E-mini, and Forex markets, but by the end of the presentation, I'm just going to show you some current Forex examples, because after all, this is FX Street. We should be mainly focusing on the Forex market. So we'll start out with examples in all markets, and then at the close, we'll just show you Forex examples. All right, here's the conventional way of trading. This is what conventional wisdom tells us how we should trade support and resistance. Here's the standard definition. Support and resistance is a concept in technical analysis that states the movement of the price of a security, regardless of its currency pairs or futures or a stock, but the security will tend to stop and reverse at certain predetermined price levels. Now, this can be based off of institutional orders. We can have a ton of orders there and buyers that are saying that we are going to stabilize this price here because this is where all the orders are and this is where all our buyers are in our institution. So this will stop and reverse at this certain level. It can be based off of Fibonacci retracements or Fibonacci levels. Somebody say, well, no, it's already predetermined in the Fibonacci support and resistance level, certain pullbacks, percentage points. So this is how I decide where we will stop and reverse. Other people will say, well, no, it has to do with volume or certain pattern recognition. You know, these are the things that we're based off of. Either way, the standard definition of support and resistance says that price will tend to stop and reverse at certain predetermined price levels, whatever you base those levels off of. Now, if we look here at an older chart of Apple, we see here that this is what most people are looking for. We see, based off this, someone would say, well, there's really no trend in this, but someone who trades support and resistance would say, no, we have a really nice complex support here, almost a triple bottom. So price should hold. This is where the buyers are holding this up. This is where the institutional buyers say it's not going to go any lower, and price should stop and reverse. This is a standard textbook of what you're looking for, right? Also, this works in the E-mini, an older chart of the E-mini here for educational purposes. We see that the E-mini has gone up to a certain level twice, almost 3 times, and it can't go any further. Therefore, there must be a lot of orders in the book. There must be a lot of institutional people selling at these levels. There must be some Fibonacci point here, something that tells us price is going to stop at this resistance and then head the opposite way. It works perfectly, right? Only trouble is this is what usually happens once you apply your own real money to it. You follow all the rules, everything you learned on the online course or you purchase, and you follow all the rules and you say, well, we have the support level here, meets everything, either the indicators that they showed me or the software I purchased, it tells me there's support here, so you look to buy and then look what happens. It doesn't work, right? All right, it doesn't work at all. And this just doesn't mean that in stocks. We can see here on an intraday chart as well. Here's a 60-minute chart of IBM, an older chart. Let's say you have some software or some class you've attended that says this is the resistance, all the Fibonacci levels or all the, what I should say, the institutional traders are selling at this point. So you want to be with them, right? You want to go along with the big money. So you sell as well, and look what happens, okay? So we can also apply this to the Forex markets. Here's the same thing with the euro dollar. This was going back last month or so. We see here that the euro dollar had been going lower and we hit some support level. We have complex support at double bottom. The buyers came in. This is where you want to buy as well because they're keeping the price held up here at this level. So you purchase and look what happens, okay? Remember, this is the way I used to trade. It will work until it doesn't work. Why? Because there's no consistency in this way of trading, waiting for that stop and reverse. And the reason is you are relying on an outside source to tell you what to do. You are either relying on thinking that there's buyers there, that they're going to hold it up so that you want to be with them and mimic them, or you're thinking that there's some support level that you've figured out through Fibonacci numbers or something is supposed to work. You're relying on that level, but you really don't believe in it because you don't really understand it. And most of the time, these things are wrong. There's no consistency. They're similar to gambling. You will play the slot machines. You'll win every once in a while. But over time, if you look to see how well you've done, you've actually lost money. You haven't made any money. Remember, our goal is to teach consistency. We're not looking for home runs. We're not looking to rely and piggyback off of anyone. In any way, we're actually looking to exploit them. So, what is the true definition and application of support and resistance? In our opinion, through my 37 years, this is really what it comes down to. It's not about institutional orders. It's not about Fibonacci. It's not about the sun and the moon aligning to make the top or a bottom in the market. Support is simply a point at which there are more buyers than sellers. That's it. And it does not mean that this point will hold. It does not mean that price is going to stop and reverse. It just means at a certain point, more buyers came in than sellers, so they stopped the price from going down. That creates support. Does it mean that it's going to stay at support? No. There's absolutely no consistency that tells you it will stop there. It's just at that point, it created some support. And then resistance is just the opposite. At some certain point in price, there were more sellers than buyers. So it created a stop movement of the market going up, and then it started to head lower. Does it mean it's not going to go any higher? No, absolutely not. It doesn't have any type of suggestion that it will stop there. It's just saying that in the past it stopped there. Okay, why? Because there were more sellers and buyers. Are there going to be more sellers and buyers in the future? We don't know, but most likely not, because remember, there's no consistency in that type of stop and reverse. Trust me, I'm saying this from experience. I'm not saying this to be condescending or put anyone down or put any trading plan down. I'm saying because this is the way I used to trade. I had privy information on where the books were when I was trading on the floor, where the large buy orders were, where the institutional buyers were. And I can tell you that the majority of the time, they would not hold at these prices. For some reason, everyone thought, well, the big buyers are there, so they should stop and hold price. It doesn't work that way. I was on the floor for 16 years. I never saw any consistency in that. Every once in a while it would work, but over time, I would give everything back trying to use this. So what we want to do is sell support and buy resistance, since there is no consistency in trying to think that price is going to stop and reverse. We don't want to rely on an outside source telling us what to do. We don't want to rely and say, well, the buyers are there, so I should do the same thing. Most of the time, they're wrong. So we want to sell support and we want to buy resistance. So what does support look like? In its most basic form, support looks like this. It's a 3-bar pattern. It's just a low, followed by a lower low, followed by a higher low. So this is your 3-bar pattern that we're going to be looking for, all right? And this is what you call support, because there were more buyers than sellers at this point. And what we're going to do is we're going to sell. Once price goes below that, we're going to sell, because there is no proof that the buyers are still there. It's just that they were there at a certain point. Resistance is just we turn everything upside down. It means that price went up, price went higher, and then price went lower. Why did it make a high here? Because the sellers came in. Does it mean that the sellers are going to stay there? No. There's actually no proof that sellers will remain there. But at this point, sellers did come in. All right? And over time, it's just one point. It's just one time when that happens. So if price comes back up and goes above this level, we're going to buy. All right? We're going against conventional wisdom. In my 37 years, conventional wisdom is consistently wrong. All right, so what a lot of people will say, well, Steve, okay, I've always been taught, the courses I take, the money I've spent, this is what I'm looking for any type of resistance. I don't look for a 3-bar pattern. I need some more proof, okay? Granted, okay, if we're going to go above here, I'll buy, but I need to see this like 1, 2, 3 times where there's some type of complex top. That's not the way I've been taught what resistance or support should look like. All right, well, this is a 60-minute chart. Let's look and see what the exact time frame looks like on a daily time frame. Guess what? It's that 3-bar pattern. Price went higher, and then went lower. So the sellers came in here. So it's the same thing. We don't need to make things complicated and look at 50, 60 bars looking back months. All we need to look for is this 3-bar pattern, because it sums everything up simply. Remember I told you, it's the easiest thing in the world to overcomplicate your trading, but it's difficult to simplify it. And most traders think for some reason if we have a ton, they're looking back 6 months or whatever, looking back at the support, adding all these indicators, this will tell us where the true support and resistance is. Oh, all you need is this. Because, this is a daily chart. Somewhere within the smaller time frame, it was giving you that. But why make it that difficult? Just make it simple. Here's another example here with the euro dollar. All right, someone would say, well, now this is what I'm looking for, Steve. This is what I've been taught. This is what they say in the course. We need some type of complex double bottom here. We need to look back at least a month to see. I need to look at the volume. I need to look and see what's going on economically in the world. I need to see where the institutions are. Too complicated. Too many outside sources that you're relying on. If we go up to another time frame, here's the weekly time frame, the same exact area we were just looking at. We have a low, followed by a lower low, followed by a higher low. The buyers came in here, that created the support. So you don't need to overcomplicate by looking back 3, 6 months. All you need to do is find this 3-bar pattern. Okay? All right. So let's look at some Forex examples now. Now we know what to look for. Now we know what we're going to be doing. We're not going to be trading conventional wisdom. We're going to be trading the correct way to trade support and resistance. Let's look at the Canadian dollar here up until the first week in August. We see here that we have a number of tops and bottoms, this three-bar pattern. In fact, these are all the different scenarios right here. So every time we go above, we want to buy this green bar. Every time we go below, we want to sell, okay? Now, we're in luck because we never went below these red instances here. So all you had to do was buy every time you went through the so-called resistance. All these different times. You see how simple that is? That's all you're doing. Every time there was a three-point top made or a three-bar top made, that is in some aspect a resistance. There were more sellers coming in. But as you can see here, by the fact that it went above means that there are no sellers there anymore. So we're not going to rely on that. I know that you would say, well, these are small time frames. If you want to see those complex tops and bottoms, just go to a smaller time frame. You'll see them there. But why waste your time? Just look for this three-bar pattern. Here's the weekly chart of the euro dollar, okay? Now we want to find those three-bar patterns on the tops and bottoms. So we see here, here's a 1, 2, 3, 1, 2, 3 top. Here's the bottom again, the bottom. And we never went above these highs, so we just went short. Very simple. Someone would say, well, this is where the support was. We don't care. We're just going to wait for that support to be broken, and that's our entry point. Remember, this is just an entry point we're teaching you today. All the full stops and exit points are revealed in our courses. How about a monthly chart? Okay, I've showed you a daily chart, a weekly chart. Let's look at a monthly chart of the dollar yen. Or I should say the Japanese yen. Yeah, the dollar Japanese yen. We find out where these tops and bottoms are. Remember, if we go below the red line, we're selling. If we go above the green, we're buying. These are that three-bar pattern. Again, a high created by a higher high and a lower high. All that means is there were sellers here. Another way of saying that is resistance. Another way of trading that is once that resistance is broken, we buy. You see how you could have been purchasing the dollar yen the entire way up. All right, now these are ideal situations. Okay, we're doing this for educational purposes. From time to time, you'll see on smaller time frames, this works just as well. Here's a 4-hour chart of the euro yen, okay? Same exact scenarios. We're looking for these tops and bottoms. You just simply sell when they're broken and buy when they're broken to the upside. And there were no breakouts to the upside. But from time to time, you'll see this, all right? Once again, those were perfect scenarios, ideal scenarios, so you can understand the concept. But many times you will see this, okay? Here's the tops and the bottoms. Every time we go below a red, we're going to sell. Every time we go above a green, we're going to buy. And so you sell here, doesn't go much lower, starts to go against you, sell again, then you cover at a loss, you buy more, you get out at a loss, you're getting whipsawed, all right? Why? Because you're in a range. This is what happened in the Australian dollar some while ago. And so someone would say, yeah, Steve, this is just as bad. I'm getting whipsawed. I'm buying at the high and selling at the low. There's no range here. So how can we alleviate this? How can we give ourselves a higher percentage for success? How do we increase our odds in every market? Well, we only buy resistance. In other words, we only buy those short-term tops in an uptrend. So we have to be in an uptrend in order to go long. And we only sell the support in a downtrend. So price has to be moving lower in order to go short. In other words, if price is moving lower, we're not going to go long. Why? Because the trend is moving lower. If price is going higher, we're not going to sell because most likely it'll turn around and reverse and go back up. So we want to go with the trend. Here's the only problem. What is the trend? How do we find out what the trend is? One trader's uptrend is another trader's downtrend. There are 1,000,001 ways to discern what the trend is. We feel at Specialist Trading we have the premier tool for finding out what the trend is, and that's the PET D. Here's what it is. It's a color bar algorithm. When you get a series of green bars, you're in an uptrend. It's that simple. When you're in a downtrend, you're going to see a series of red bars. This is a proprietary algorithm that I learned on the trading floor that many of the floor traders were using. Unfortunately, at the time, 35 years ago, you had to calculate this by hand, and therefore you could only do it on a daily basis for daily bars. Couldn't be used intraday or couldn't be used in smaller time frames because it was too difficult to calculate for every bar. So now, with the advent of high-speed computers and programmers, we were able to have this in any time frame, in any direction. So we have a proprietary short-term trading tool based on momentum. All right, so here's what we want to do for a buy pattern now. We're going to look for price to trade above an all-green pivot high, all right, those short-term tops. But so we're going to buy when price trades one tick or one pip above the pivot high. So if we look here, this is what we were calling resistance before. And we were buying when it went above there, just anytime we saw that. But now we want all these bars to be green. That's the only time we'll buy above this little 3-bar top. And for selling, we're going to look for price to trade below an all red pivot low. All right, we're going to sell when price trades one tick or one pip below the pivot low. So previously we were looking for this sellers, more sellers, then the buyers came in, so a higher low. So we were looking for this 3-bar pattern. And once price went below, we were going to sell. But now we're not just going to blindly take that. We have to have all of these bars red in order for us to sell. Remember, we want to go along with the trend. We want to be in sync with the trend. We're not caring what the institutional orders are doing. We're not caring what volume is doing. We don't care what's going on economically in the world. We don't care what the news was. We're just following the momentum of the market, because the market is the only thing you should be listening to. Remember, don't overcomplicate your trading. The way we do that is by listening to too many outside sources. Only listen to one thing, which is the market, and the PET D is a great way to teach you how to listen to it. It tells you what the market is doing. So let's look at some Forex examples here. Here's a current chart of the dollar yen taken up until yesterday. Obviously, we're in an uptrend. All the bars are green. So the first thing we want to do is find those little short-term tops, the so-called resistance. At each one of these points, someone could have said, some guru or some trading platform could have said, this is where we have resistance, this is where the sellers came in, and it's going to hold. We don't care about that. We just see that it was this high followed by a higher high and a lower high each time. So when we go through that, that's our buy point. And so if we go through it again, we can go higher. Okay? I saw a lot of things yesterday, the last current days, where people were saying like, well, there should be some support at 106 on the dollar yen. You know, we're not interested in support. We're only looking at resistance at this point. Someone was saying this is where support was right here. I don't know what that's based off of, but all we look for is resistance when the market is going up. That's all we're concerned with. How about the euro dollar? This was taken yesterday, okay? Obviously, we're in a downtrend, and the PET D is coloring all the bars green all the way back to July. So in July, the PET D was already telling you we're going to be in a downtrend. Don't look to buy anything. Wouldn't you like to know that from the market rather than some guru or some platform or some course telling you, well, no, we don't think that the euro dollar should be sold here. It's probably bottoming out. Why not just listen to the market? And the PET D reflects what the market wants to do. So at this point, way up here, we started having this consistency of red bars. So the euro dollar, in our opinion, was headed lower. If it's headed lower, we want to look for these short-term support levels. Why? Because support levels are made to be broken. Most people that call for support, such as right here, are usually consistently wrong. All right? So we want to go against that and trade with what the market wants to do, not with what someone is telling you what to do. So you would have sold the entire way down. Do you see how easy it is to trade support and resistance when you trade it the correct way? How about the British pound on a weekly time frame? Well, here's two examples here. We see that the first example, the first part of this chart, we're going up and all the bars are colored green. As far back as September of 2013, all right, we're talking about a year ago, the PET D was already coloring the British pound green, telling you that we're going higher. So all you need to do is look for these little short-term tops, the so-called resistance. Now, there were a number of places here where I'm sure people on TV or newsletters said you have to sell the British pound on a weekly basis. We've hit some number of support right here, or I should say resistance right here. It's having a difficult time. As long as the PET D is green, we're going higher. It's telling you we're going higher, and we just want to buy every time we break out above, okay? Don't listen to outside sources or trading platforms telling you what to do based off volume or the colors of the moon or whatever. Just listen to what the market's doing. Now, later on, guess what? We had our first red bar, which was just last month in a weekly bar in the British pound. So at this point, this was telling you the trend is most likely going to change. You could have exited all your positions. Sure, you would have taken some losses at your purchases up here, but look at all the gains you would have made way down here. All right? So you could have exited everything based off this, and then look what happened. We ultimately went lower, okay? So look at the great indication way before anyone told you or to get out of the British pound. The market was telling you to get out roughly at 6,800 before it went down another 8,000 pips, okay, or 800 pips. Now, someone would say, well, okay, so I guess I'm supposed to be selling. There's no short-term bottoms. Well, you could have gone to a smaller time frame. If we look at this time frame right here, starting back in July and August, we could have gone down to a daily bar chart, all right? And now that we go to a daily bar chart, we see that all these bars are red. We look for the short-term lows that were created. And look at all the times you could have been short the British pound. This chart was taken up until yesterday, I believe. So, it's that easy. Why? We're not concerned with any news. We tell our students, don't worry about, economic indicators. This whole time, if I go back just in reverse here, this entire time the British pound was going up the past year. Don't you think there were a lot of economic indicators that came out that were negative or positive or, giving you a bias as to what to do? It didn't matter. All we were looking at was the color of the bars and deciding what to do once we went above a high. So there's always going to be excuse not to trade, either what someone's saying or some indicator is coming. We don't care about that. Just listen to the market, as you could have done here and gone short the British pound all the way down. If we look at a monthly chart of the euro yen, we see here that on a monthly basis in November of 2012, we were actually red bars until we finally turned green. So this was telling you roughly in 2012 that we're starting an uptrend in the euro yen. Okay? Once all the bars are green, what are we going to do? We're going to look for those short-term tops, and we're going to buy once those tops are violated. All right? Now we still are in green on a monthly basis and near the tops that have been created that if we go above them, then you will buy if you're trading on this time frame. We realize not everyone trades monthly. I'm just trying to show you for educational purposes that this technique just doesn't work on daily bars or on weekly bars. I've shown you intraday bars, I've shown you monthly bars, I've shown you stocks, futures. It transfers over into all markets and all time frames. Here's a weekly chart of the euro yen. Now, obviously, the monthly chart was green. The weekly chart is red. We only trade the chart we're looking at. I know a lot of people like to say, well, Steve, how can I trade the weekly short if the monthly is green? Remember, don't overcomplicate things. I know a lot of people say, well, both time frames, the higher and lower time frame, has to justify each other and be in sync. It's up to you. I've only found that there's no consistency in that type of technique, and all it does is keep you out of a lot of good trades. In other words, if I listened to the monthly time frame, which is all green, I would have missed all of these shorting opportunities on a weekly time frame. So I only personally trade the chart I'm looking at. I don't look at a higher time frame to tell me what to do on the lower time frame, vice versa. It only serves to keep me out of a lot of trades. I don't find a lot of consistency in this. I know, once again, this is conventional wisdom telling you this is the way you're supposed to trade. I've been trading for 37 years. I have never found any consistency with this and or trading support and resistance the way you're supposed to trade it. All right, so let's recap. We showed you the conventional definition for trading of support and resistance. Okay, what it means is that price will hit some point where it will either be labeled support and or resistance, and then it will reverse the trend. Okay, so what most people try to do is go along with that support. In other words, if that's where the big money is, the institutions, the buyers, well, I want to be with them, right? Because they're always wrong. It's been my experience that they're usually, they're always right. It's been my experience that they're usually wrong. And they just have big pockets so they can keep coming back another day and look for the home run. See, they're looking for home runs. We're looking for consistency. And so they can be wrong a lot of the time, which they are, but they hit a home run every once in a while, which gets them back in the game. We can't afford to do that with our smaller accounts. Even if we have a $100,000 account, that's nothing compared to them. So what we want to look for is consistency. And there's no consistency in that conventional style of trading. Once again, I'm not putting down anyone's program, anyone's platform. I'm just saying from experience, I used to trade this way. I used to have all the support levels based off of where the institutions were because I had this privy information. I saw in my book where the buyers were. And guess what? It would work 3 or 4 times. The 5th time, I gave everything back. There's no consistency in that conventional wisdom. So what is the true definition of support and resistance? The true definition is support equals there's more buyers than sellers. At a certain point, there were more buyers than sellers. Does that mean it's going to hold? No. There's no proof it will hold. At a certain point, there are more sellers than buyers. That's why price stopped and moved direction. Does that mean that will continue? Absolutely not. There's no proof that that will. So what we want to do, since everyone is trading that way, is to go against that. The correct way to trade support and resistance is simply to wait for those so-called support and resistance areas to be violated and go with them. But the only way to really have consistency in that is to be in sync with the trend. In other words, we don't want to buy resistance if we're in a choppy trend or a downtrend. We don't want to sell support if we're in an uptrend. So we have to know what the trend is. Only trouble is, it's very difficult. Everyone knows you should be in sync with the trend, but if everyone knows this, why aren't 80% of all traders profitable? It's the opposite. 80% of all traders lose money. And one of the main things we're taught in the beginning is be in sync with the trend. And I think the reason why most traders lose is because they don't know how to find the trend. Everyone has a different, every educator you go to, every platform has a different way for finding the trend. And so it's too confusing. We feel at Specialist Trading that we have the simplest and most basic way of finding the trend because it's based off of what the market is telling you, and that's the PET-D tool. It's our proprietary tool that I learned some 30, 35 years ago on the floor. I've been using it ever since. Now, in conclusion here, before we go into any questions and answers, please remember one thing. If there's one thing you take from this educational webinar today, all right, even if you don't trust or believe anything I just shared with you, just remember what my mentors taught me, because this is what turned my trading around. When I was suffering, when I was really struggling and I couldn't make a dime, this is what turned my trading around. When they said, Steve, it is the easiest thing in the world to complicate your trading. Anyone can do that. You can be trading 30 years, 30 minutes. It doesn't matter. You can put 1,000,001 things on your trading plan. You can look at tons of news, tons of indicators, look at all the institutional buyers, volume, anything you want to. But that will only serve to complicate your trading. It's the most difficult thing in the world to simplify your trading. Why? Because we want to hang on to these things because for some reason we've been taught that they're true. And there's no truth or consistency to them. It just seems like the right thing, but there really isn't any consistency. So remember, we're trying to teach you how to be consistent at Specialist Trading. We give you all the things I've accumulated in my 37 years so that you can ultimately take them, devise your own plan, and then be able to decide your own trading decisions. We never want you to rely on an outside source to tell you what to do, whether it's a platform that generates buy and sell signals, or whether it's a strategy, or whether it's some trading guru in some chat room. We want you to say, well, you know what, I've done my due diligence, I've done my homework, this is what I think is going to happen based off of sound fundamental education. And this is what we give you at Specialist Trading. So here's our PET-D, the Primo Early Trend Detector tool. As you can see, it's a roadmap for any market. The best thing is that it works great in the Forex markets, but you can also use it with stocks. As we showed you, you can also use it with the Forex markets. It's a proprietary color bar algorithm based on momentum. It's not based on volume. It's not based off the tides of the ocean. It's not based off institutions. It's not based off of open, low, high, low closes. It's just a momentum formula that you have to simply calculate, and it's a proprietary algorithm, so we do that for you. This includes the add-on so that you can ultimately just have it onto your platform, and whenever you want to be watching the PET-D, I have it on 24/7, but you just turn it on and it automatically turns the bars either green or red. With this, we give you 2 continuation trading techniques, all right? We also give you 2 pullback trading techniques, all right? Also, we teach you in the course a trailing stop technique. So remember, you can apply this to any market, any time frame. And then lastly, you have access to my personal email address. So you can contact me whenever you want with questions. Now today, all I shared with you was an entry technique. I know a lot of you may be saying, well, where do I place my stop? What do I get out of this thing? All right? That's in the course. I'm sorry, it wouldn't be fair for the people who've already purchased the PET-D course for me to just give away all the rules for free in a short webinar. It's not fair. You wouldn't like that if you had paid. So I'm giving you a great entry technique, which is what most people like. If you have any type of sound, risk awareness where you know where a stop should be, and if you know risk-reward ratios where you'd like to use 2 to 1, 3 to 1, you can use those as your exit levels and stop placement. It's really up to you. The most difficult thing is learning where to enter. And this is what we teach you in the course. Best thing about this is that we have discounts for our FX Street attendees. So remember, we share with you that link, the microsite. Kindly go to the microsite, read more about myself and our websites, and go to Pro Trader Strategies, which I'll share with you here in just a moment. I just want to share one last thing. A lot of people say, well, you know, Steve, what about different time frames or different markets? Here's a long-term approach to the PET-D. This is a monthly chart of the S&P index going all the way back to 1994, 20 years. Now look at all the great swings the market has had from straight up to straight down, straight up to straight down. If we add the PET-D, look how it caught those great big movements. Remember, in order for us to have a valid change, we need to see anywhere from 2 to 3 different colored bars. Every once in a while you'll see a splattering of one bar that is opposite, but we need to see 1 or 2 consistent bars to know that the trend has changed. And look here, just in this example, how you could have caught all those different changes just by applying the standard PET-D. This is how great of a tool this is. This is why we swore by it on the floor of the exchange. Now, for more information, go to our sister site. That's protraderstrategies.com. That's our sister site. They market and promote all of my individual courses and strategies. Or you can contact them 2 ways, either by emailing them at trading@protraderstrategies.com or simply call them directly at area code 310-598-6677. They handle all of the prices and all of the discounts, and tell them also that you were also a FX Street member. So you can also find that on the link that I gave you for the discount for the FX Street microsite. There's a lot of great information there as well. Tell them you were FX Street, you saw the FX Street presentation, and you can go to the microsite, also look for discount. But please remember, I deal with the teaching aspects. That's all I do, is I teach and mentor my students. The people at Pro Trader Strategies share with you all of the different types of discounts and payments you can do. They also offer payments so that you can devise some type of monthly payment plan as well. All right, thank you. We have about 10 or 15 minutes left here for questions. I'm going to open up the question and answer box, and I want to thank you all so much for waiting. Let me just see here. So Steve, what is your view on the euro-dollar pullback to 13,250? Well, remember, we let the market tell us what to do. In order for me to say that it's going to pull back to 1.3250, that means I have to have some level in there that's based off of some support or resistance, some Fibonacci. I'm letting the market tell me what to do. And the market gives you signs. Now, either it's going to get up there and it's going to stop and reverse, or we need to get to that point, and we need to see certain things meet our requirements in order for us to say that something is worth looking at as a pullback. One thing that we know is that many times if price, say we're in a downtrend, such as we are with the euro dollar, and we start to go back up, but if we see that the PET-D changes to green, well, that's not a valid pullback in our mind, because we're not going to, we only short things that are red in the PET-D, and we only go long things that are green. So if we get back to that level, but the PET-D is green, we will not take that as a valid type of sell. So we have to get to these points, and we have to then review everything. But remember, what we do is extremely simple. Most of our members are people that have just been trading for a couple of weeks to a couple of months. And so it's not something where it's extremely complicated. You see how simple it is. You see the PET-D. If the colors are red, we look to sell. If they're green, we look to buy. It doesn't get any more simpler than that. Okay? Joe is asking where to place the stops. Once again, Joe, that's in the course. It wouldn't be fair to the people that purchased to just give away all the information for free. Just out of curiosity, can the PET-D be green in one time frame and red in another time frame? Yes, very good question, and yes, it can be. But remember, this is where we say conventional wisdom. Most people, for some reason, have been taught that the higher time frame should be in sync with the lower, and vice versa. This way, you're in sync with both time frames. You can do this. You know, we're not going to tell you you can't trade this way. We know we have a number of students at Specialist Trading that swear by this, and that's fine. If you ask me personally, I don't trade this way. I don't care if the higher time frame is green. If the lower time frame is red, and that's where I get a signal, I'm selling it. I don't care what the higher time frame is, okay? Because I only look at each individual chart for what it is. The other way of waiting for the higher time frame and the lower to be in sync is fine I have personally not found any consistency in that. The only thing I found with that is that it keeps me out of good trades. So if I used to use that, I would stay out because they weren't in sync, and then I missed a great trade. And I say, why didn't I just do it? I was waiting for them to both be the same color or both be in the same trend, and they're not. So I missed a trade. So I personally have found no consistency, so I don't use it. As you'll see, I mean, I've been trading for 37 years. I've been around long enough to see what works and what doesn't. And the majority of things that we've been taught that are supposed to work really great, all the things we've been taught about support and resistance, all the things we've been taught about trend, all the things we've been taught about certain strategies, most conventional wisdom actually doesn't work. Because if it did, if these were the basic things, then the majority of all traders would be profitable. And it's the opposite. The majority of most traders I should say the majority of traders are not profitable. So what does this mean? It means that there's no consistency in these. So what you need is just sound basic education, and then you need someone to mentor you so that you can ultimately just make your own decisions. Next question, how many bars are allowed before price moves higher, lower than the entry price? Well, remember, we're only looking for the bars to be the same color. So as long as the bars are the same color, we're looking to enter either short or long. And we usually just enter right when price trades 1 to 3 pips below or above that certain support or resistance level. That's it. We don't wait for a certain amount of bars. If we trade 1 to 3 pips above a resistance, we're in. If we trade 1 to 3 pips below support, we're in. Okay? Should you get in sync with the support resistance is broken in an open candle or when a candle closes above or under the level? Remember, it doesn't matter what type of chart, or I should say bar chart we're looking at. So it doesn't matter. I showed a lot of candles just to show you how well the PET D works with candlesticks, because I know a lot of Forex traders use it. But when I do the same presentation for stock traders, I just use standard bar charts. It doesn't matter what chart we're using, what type of bar chart we're using. All that matters is we find that 3-bar pattern. And it doesn't matter if we close above or below there. If we trade intraday 1 to 3 ticks or pips above, we go long. It could close below there, that's okay. But that's all we care about. If it trades 1 to 3 ticks below, then we go short. It could bounce and go back up, that's okay. As long as the bars are red, we're going to stay short. As long as they're green, we stay long. And then we teach you where to place your stops. Because once again, this is not 100% foolproof. I would never tell anyone that this works 100% of the time. But I've just showed you current charts in just about the major Forex markets where it does work. And these are charts where it's current as today or yesterday. So, it will have these nice strings of consistency. Every once in a while, you have small minor losses. But remember, we're about consistency. 2 steps forward, 1 step back. We're not about hitting home runs. Every once in a while, we will hit a home run with the PET D and any of our strategies, but we're more about hitting these nice little singles so that we can be trading 20, 30, 40 years. Let's see. It says, Steve, if price has passed the entry level, you can get in. What is the price goes the other way? What's still but still above your stop level? Can you get in then at a better price? Yes, in other words, let's say you miss the basic entry and it goes the other way, so now you can get in at a cheaper price. That's okay. I don't usually like to trade this way because basically I'm just trying to manipulate or reformat the plan. It's okay if it's a logical miss. Say you had to go out and run some errands, or say you were sick that day, and then the next day you say, well, it's even cheaper. I would have naturally bought it or sold it. It's even cheaper today. That's fine. But if you're waiting to do this, that's a totally different way of trading. I personally don't like to do this, but we also have risk management plans where we actually kind of use this technique to cut your risk down. And that is part of a plan, so that's okay. But if you're trying to manipulate it, that's a totally different thing. So it depends on what your motivation is. If you're trying to get a better risk-reward ratio, that's okay, because you have some type of structure to your trading. But if you're just trying to hope and pray that, boy, I hope price goes lower. I know I should have bought it here, but now it's lower, or I'm praying for it to go lower so I can get a better price, you're pretty much just gambling mentality, okay? Yes, as you see there, FX Street Sokami has given you the link where you can find the services in our website, in the FX Street website. That's the link they put together. Okay. Lastly, someone says, what is the hit rate for this strategy? Once again, The only way you can define hit rate is by having a system. That means everything is traded the exact same way each and every time. That means everyone exits at the same point, everyone enters at the same point, everyone trades the same time frame. As I stated in the opening segment here, we are an educational company. We're not a statistical company. We don't give statistics on this sound fundamental information that has stood the test of time, because everyone trades differently. I've said over and over that what we do is we mentor you to fit your style so that you can make your own trading decisions. If our whole philosophy is designed for you to make your own trading decisions, we can't have a hit rate because everyone's going to trade it differently. Someone may go in for a quick in and out and make a quick 20, 30 pips. Someone can stay in for the long run and make thousands of pips. It's up to you. But we're not a statistical company. We don't keep records in terms of that. We just try to give you real high probability scenarios for you to become consistent. Could I repeat the discount link, please? Yes. Well, if you go to the link there, if you see it's on your chat room there, FX Street has kindly pasted the link. You see there, fxstreet.com/services/education/pro-trader-strategies. That's our sister site, which generates all the different discounts. And remember, we also have payment plans. So you can speak to one of the trading consultants. You can email them or call them directly at the number provided, and they can put together some type of trading plan for you. Okay. Let's see. So you get in on a lower time frame in the same direction? No, I don't. I think I went over that. I just trade the time frame I'm looking at. But you can do that. So in other words, let's say when we saw the British pound, all of a sudden on the weekly chart was going straight up in green, and then the first red bar appeared. Okay, well, let's say you say, well, I don't have enough money to hold lots overnight on a weekly time frame. I don't want to carry positions that long. I'll go down to the smaller time frame, which is the daily, and you see there that all those bars were red as well. Now you can do that if you'd like. I have nothing against that. I personally don't trade that way. Okay, so I don't do that at all. All I do is just trade the time frame I'm looking at, and so I wouldn't care what the higher time frame is doing. But that's up to you. Okay. Once again, I know a lot of people have sworn by this technique. I personally have found no consistency in that. Okay, we're just about at the end here. I want to thank you so much once again. Remember, we're an educational company. I'm just trying to educate you and just open up your eyes to seeing things for what they really are. I know a lot of educators, a lot of programs, a lot of people on TV tell you the conventional way of trading certain things, certain ways. I have found in my 37 years that there's no consistency in that. Our whole goal is to get you to be a consistent trader. We're not promising to make you riches. We just want you to be trading 20, 30, 40 years, because that's really what it's all about. I've known traders that made hundreds of thousands, if not millions of dollars in a relatively short time. And guess what? They've all lost it. They gave it back. And many of them are not even trading anymore because they lost all their money. So there's no point trying to hit home runs. What you really should be looking for is consistency in your trading, and that's what we teach at Specialist Trading. Simple things that I personally use that have stood the test of time. I want to thank you, and I especially want to thank FX Street for giving me these opportunities to present these presentations on a monthly basis. I thank you so much for attending today, and I look forward to all of you becoming members of Specialist Trading and the PET D course. Thank you so much. We shall see you next time. Bye-bye.